Okay, let's talk about it. What is the single biggest mistake? The one thing that just destroys most investors? Well, it turns out the key to protecting yourself, comes from a really unlikely place. A casino. Yeah, you heard me right.
So what is that deadliest sin in trading? What's the one thing that can just completely wreck your entire journey? Before I just give you the answer, I want you to meet someone. Let's call him Rahul. Now, Rahul's feeling pretty good about himself. He's been trading for a bit, he thinks he knows the ropes, he feels like a pro. But what he doesn't know is he's about to make a mistake so big, it could wipe him out completely.
And there it is, one word, concentration. Putting all of your eggs in one single basket. So what happens, Rahul gets this tip, a short tip from his cousin, you know how it goes, about a company called Lakshmi Chit Fund. And he thinks, this is it, this is my big break, I'm going all in.
His motto? Risk hai to ishq hai. If there's risk, there's romance. So completely blinded by this hot tip, he does the unthinkable. He sells off all his good, safe, stable stocks and puts everything, his entire life savings, we're talking 5 lakh rupees, into this one single bet.
And what do you think happens? Bam, the result. News breaks that the company is being investigated for fraud. The stock just tanks. It hits the lower circuit, meaning he can't even sell if he wanted to. And then it does it again the next day. In just 3 days, 72 hours, half of his entire net worth is just gone.
Okay, so let's talk about thinking like the casino and how the house always wins. Rahul is obviously devastated, right? But his mentor, this brilliant guy they call the Quant Guru, doesn't scold him. Instead, he decides to share a really powerful secret. And it all starts with a little trip to a metaphorical casino.
The guru asks him a simple question. Why is the casino owner never worried when someone hits a big jackpot? Think about it. One guy at a table might win big, right? A huge payout. But is the owner freaking out? No way. Why? Because the casino has hundreds of tables, thousands of little bets happening all at the same time. They couldn't care less about one single outcome.
And that's the huge difference, right? You've got the gambler versus the house. Rahul, he was acting like the gambler. He made one giant bet and just prayed for luck. The house, on the other hand, makes thousands of small bets. They have a statistical edge, and they're completely indifferent to any single outcome. The guru tells Rahul, you need to stop thinking like a gambler. You need to start thinking like the house.
Okay, next up, the Laddoo Theory. This is a delicious lesson in risk. To really make this point hit home, the guru uses an analogy that he knows Rahul will get. His favorite sweet, Laddoos.
He calls it the single box mistake. And it's so simple. It's brilliant. Imagine you put all of your Laddoos, your entire investment capital, into one single, kind of weak box. Then, step 2, you trip and fall. A single stock crashes. What happens? Step 3, all your Laddoos are destroyed. Every last one. It's a perfect metaphor. A single bad event can completely wipe you out if everything is in one place.
And believe it or not, this simple Laddoo theory is basically the core of a Nobel Prize-winning idea called modern portfolio theory. Harry Markowitz literally won a Nobel Prize for proving mathematically that spreading your Laddoos, your investments, across different boxes lowers your overall risk without even necessarily lowering your expected returns. The goal isn't to pick the one magical winner. The goal is to make sure one loser can't take you out of the game. All right, Section 3, the correlation trap, or why different isn't always diversified. So a light bulb goes off for Rahul. He's excited, he gets it, or he thinks he gets it. His first attempt at diversification is, well, it's a classic mistake, and a really dangerous one. So here's Rahul's diversified idea. He proudly tells the guru, okay, I'm going to buy 5 different stocks, HDFC Bank, ICICI Bank, SBI, Axis Bank, and Kotak Bank. You can just imagine the guru doing a massive facepalm. He tells him, Rahul, that's not diversification, that's suicide.
And you might be wondering why? They're different companies, right? Well, yeah, but think about it. They're all banks. They're all in the same box. This is not diversification because these assets are all highly correlated. If some bad news hits the banking sector, let's say an interest rate hike, what do you think happens? They all fall together.
So let's break down this idea of correlation. This is the secret sauce. Look at HDFC Bank and ICICI Bank. They have high correlation, they tend to move in the same direction. But what about something like stocks, say the Nifty and gold? They often have low or even negative correlation. They move in opposite directions.
When stocks fall, people get scared, and they often rush to buy gold for safety. So as one goes down, the other can go up. That is real diversification. Okay, so let's get to the good stuff. Building your fortress. This is what finance folks call the only free lunch in the game. How do we actually do this?
The key is an uncorrelated portfolio. You want bets that don't talk to each other. So you might have some Indian stocks in there for growth. You've got gold for safety when things get scary, maybe some government bonds for that steady interest income. You can even have different types of trading strategies. The point is, if one part of your portfolio is down, another part can be up. They balance each other out and protect you.
And this is what it might look like. A diversified fortress, maybe 40% in stocks, 20% in gold, 40% in bonds. Now, Rahul isn't stressing about every single piece of news. He's not losing sleep. He's built a fortress. And the guru's final piece of wisdom is so true. A trader who sleeps well, trades well.
So, there you have it. You've secured your Laddoos. Your fortress is built. But let me leave you with this question. What one thing could still wipe you out? Rahul has learned his lesson about diversification. But there's one final trap. A mathematical lever so powerful, it can bring even the most diversified fortress crashing down. We're going to talk all about that in our next explanation.